Well, welcome everybody. Good, I guess good afternoon. We'll give just a minute. We just opened up the doors. We got a pretty big group today, so we'll give maybe a minute or so to let everybody get in and get set up, but we'll get started here in just about a minute or so. Good afternoon for those that didn't hear me the first time. We're going to give just a minute or two as we just opened up the doors to the room, and so we'll get started here in just a minute. All right, it looks like most have filed in. Thank you guys very much for joining us today. My name is Jason DeBono, Vice President here of Newview Trust Company. And today I'm going to walk through fair market valuations. And this is something that comes up a lot. And as we get towards the end of the year, this is something that becomes more and more important. So whether you already have a self-directed IRA or whether you're considering a self-directed account or whether you maybe manage assets that your investors have invested into through self-directed accounts. Hopefully today will shed a little bit of light and clarity. I want to start with a couple of disclaimers. First of all, I've been doing this 14 years. The world has shifted a little bit, which is great. We've gotten a little bit more information. 14 years ago, when I first started, valuations were kind of a, well, if you have them, you have them. If you don't have them, you don't have them. And that was kind of across the industry. And then it slowly started, the regulatory bodies in this business have started to kind of shed some light and say, hey, we probably need to make sure that we have, valuations, and this is exactly what's required. Even though it's hard to value, we can't just rely on purchase price. And so that's kind of the basis for, our discussion today is where we stand today. Couple of house cleaning tips and a couple of disclaimers. Number one, I am not the IRS. I cannot speak for the IRS. I'm not an attorney, CPA. I can speak as a custodian. I can speak as to, what our regulatory bodies tell us. But at the end of the day, it's always the IRS, especially when you get into some taxable related events, that you want to make sure that you're satisfying any requirements they may have. As far as today's webinar goes, if you do have questions, there's a Q&A option on on your screens. Feel free to type those in. I will pause every couple of minutes and take some questions so long as they're coming in. But please ask them. There's a lot of you on the call today, and I hope that we can get some good interaction going. We put together, presentations based on the questions that we're familiar with and what we get, but it may not necessarily answer the questions that you have and the reason you joined us today. If at any point you feel like there was something that was unclear or you need a little bit more information or depth on that, just put that into the question window there. It will pop up here on my screen and we'll get that read aloud. So as we go through this, make sure that you're not relying on your custodian, whether that be Newview or anyone else, to be the tax or legal experts. Every custodian in the self-directed IRA space operates under a non-fiduciary, non-advisory, non-tax standard. Therefore, what we're going to cover today is kind of what we see and know and understand in the marketplace. But as I mentioned, obviously, it's the IRS that ultimately makes the final decisions inside IRAs. So as we go through this today, and so the first thing is, what is fair market value? And I'm going to read this verbatim because this information comes from a couple different sources. But fair market value is the price at which property would change hands between a hypothetical willing buyer and a hypothetical willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. Now, this goes back to U.S. versus Cartwright, an older case, not necessarily IRA related, but valuation related. The IRS also has this published in a few different places. I believe one of them is publication 561. They use very similar language. And then there's also some revenue rulings that also go back to this. Now, the IRS has not produced a specific set of code that says this is how you value these types of assets in IRAs. So understand that doesn't exist. And so what the industry experts and those in this business and the legal scholars that understand this business have done is they go and pull from all the applicable places where it seems relevant. The second bit of information is actually from the United States Government Accountability Office. Now, this group, provides information and reports to the IRS on things that they could do differently, better, and so I would encourage you, if you want to go and spend a lot of time reading, to take a look. It's GAO 17-02. There's a lot of information in there. There was a lot of research done on how self-directed accounts work, the types of assets that are held. And basically their conclusion was current IRS guidance includes no guidance or advice to custodians or IRA owners regarding how to determine fair market value. And so they determined after this lengthy study, and it's many, many pages long in terms of detail, but they really determined that the IRS doesn't give that. And so they encouraged that the agency actually produce a level of instruction or guidance, because they want to make sure that taxpayers understand the rules and can adhere to them. So in kind of going through this, what it tells you is really a couple things. Number one, there's a very general approach to fair market value that the IRS has relied on over the years, and that is willing buyer, willing seller with relevant information, right? Willing buyer, willing seller, relevant information. The second piece of that is that it's clear, right, that there is no deliberate or expressed approach in finding fair market value. So we want to make sure that we talk through what that can and may look like. And then obviously as the IRA owner, you have to navigate that process. Now, some assets are much easier to ascertain value on than others. And we'll talk a little bit about that as we go through this information today. Remember, if you do have questions, I know there's still people joining. If you do have questions, please be sure to type those in and we'll get those read aloud. So types of assets considered hard to value. Now, I told you when I mentioned I started doing this 14 years ago. Early on, really all the way up until 2015, the IRS simply received from custodians one number, which was the fair market value of your account. So if you had $50,000 piece of real estate and $50,000 of cash with NewView, we would report prior to 2015 to the IRS that you had $100,000, under our custody. We would not list any other information. So we don't provide value of each individual asset. We don't, at that time, we didn't provide the types of assets held. In 2014, effective 2015, the IRS made some modifications to the custodial reporting documents because they want and understand that they need to get some clarity on what types of assets are in fact being held inside retirement accounts. And then furthermore, is there enough of these types of accounts and types of assets that should warrant us providing additional guidance? And is there an opportunity for us to understand the behavior or different behavior of clients that are holding different types of assets? And so they produced information out to the public, but this came right off their website. You can see the link down there. It was done this came out in 2004. But the new information was proposed for investments without a readily available fair market value. And they determined those assets would be non-publicly traded stock, partnership or LLC interests, real estates and options, and then other hard to value investments. Now, as custodian, I can tell you, if we were to take all of the holdings that were non-traded stock, partnership, interests, or real estate, it would probably be about 75% of what our clients do. Promissory notes, even though they are considered an alternative, and we have a significant amount of clients that do that, they really aren't hard to value assets, right? And they're not hard to value as a general term. These tend to be the items that get a little bit harder to really determine a true fair market value. This had impact and effect on both Form 5498. That is a form every IRA custodian produces. So whether you have an account at NewView or Charles Schwab, every custodian by May of each year produces to the IRS a declaration of what of your account value as of 12/31 of the previous year. Now included in that, under annual reporting, are code boxes. Now, I don't expect you to go through and read all of these, but the IRS now, as of 2015, has custodians indicate the types of assets that you have inside your account. So we still do not produce a listing of each unique asset. So when we report to the IRS, NewView or any other custodian does not list out each item individually. There is still one section for the total value. But now 15B asks for the codes that may apply. So if you own, for example, $50,000 of cash and $50,000 of real estate, we would report to the, on Form 5498 under 15A, we would put $100,000. And under 15B, we would put D to let them know that some or all of that $100,000 is made up of real estate. And we could insert any other code to reflect that. In addition to annual reporting, there's what we refer to as tax reporting. Tax reporting has to do with an activity that may generate a tax liability. So 5498 is a required form for every single account holder as of 12/31. There's no optional portion of that. We will report that for every one of our clients that had an IRA with us as of 12/31 of the preceding year. Taxable reporting, which is 1099-R, is a form that we only, and I say we, any custodian, would only report if you generated an activity that may be taxable. And the three general uses for that are distributions, so you physically took money out of your account. Conversions, right, meaning that you took money from a pre-tax IRA account and moved it to a Roth account, as well as any potential rollovers inside that. So if you're taking money from one account and moving it to another, it very well could produce. It falls under the distribution category, but we would still talk about that slightly differently. So anytime money leaves an IRA account, there may be a 1099 produced. Whether or not you have tax liability as a result of that 1099 is between the account holder and the IRS. So no custodian determines tax liability. What is new in 2015 is there is a code K when you request a distribution of an asset. So I'm going to go back to that same example, $50,000 of cash and $50,000 of a piece of real estate. If you were to request your cash, $10,000 as a distribution, or do a Roth conversion, we would submit a 1099 to you and to the IRS that says $10,000 was withdrawn. Now, we don't have to use any codes other than to reflect if it was premature or other items, but we don't have to use an asset code because it's cash. There is no question on what its fair market value is. But if you would have taken that $50,000 piece of real estate and converted it to a Roth IRA, or taken that $50,000 asset and distributed it, we are now required to put a code K onto that distribution form to let the IRS know that this number is based on a hard to value asset. And that's why when we talk about annual reporting and tax reporting, it's very important to understand there may be a slightly higher standard of fair market value for tax reporting events versus annual reporting events. I'll pause there and see, I don't see any questions at this point. If you do have them, certainly continue, now would be a great time for you to go through that. So let's talk a little bit about what we see in the industry. Now, for the sake of discussion today, we're going to talk through 4 different types of asset classes. Number 1, real estate, one of the most common asset classes in self-directed accounts. Number 2, we're going to talk about promissory notes. These are debt instruments, and we'll talk a little bit more about those. Number 3, we're going to refer to as checkbook LLC or some sort of asset holding entity. Now, what I mean by that is, for those that are familiar with checkbook LLC, that means that you've set up a self-managed LLC to buy an asset or two, and you set it up for simplicity, or you set it up maybe to avoid fees, or you set it up for a little bit more control over the property. But at the end of the day, if you were to strip the LLC away, you'd have a couple of assets there, right? It's not an operational business, it's merely a holding group. That also is in the form of land trusts we see commonly used to hold assets. So again, we're talking about assets that are non-operational from a business perspective, but rather used for the purpose of holding a particular asset. And then lastly, operational entities. Now this can be LLCs, limited partnerships, C Corps. It cannot be S Corps because IRAs cannot invest into S Corps per the S Corp rules. But when we talk about operational entities, these are actual business interests. So there is operation here. So we're not looking at what's the piece of property in that entity worth. We're looking at what's the value of that business enterprise. So a lot of times when we talk about the holding type entities or checkbook LLCs, those tend to be valued based on their assets. Whereas when we start talking about operational entities, they start being based on or valued based on their business value. And in most cases, that has to do with revenue or earnings. And we'll talk through that here. The second thing is you'll notice some different colors. Now, that's not here to make the slide confusing. It's there because I want to make sure everyone understands there's a different threshold between an annual valuation and what would be considered a taxable valuation. Two completely different things. And they very well could be one and the same. And it's important that you understand where you are from a tax standpoint and where you are from a valuation standpoint so that you're providing you have the best chance of providing the IRS with the level of valuation that they're going to be looking for. So when we talk about annual valuations, this has to do with a client that has no tax liability from their IRA. They're not taking distributions or withdrawals. They're not over retirement age. They're merely putting money into the account, or I'm sorry, they've put money into the account, they've bought assets, and they're just maintaining that process throughout the years. That's what we refer to as annual valuation. Taxable valuation would be if you're going to be withdrawing or converting or distributing those particular assets, or if you have some sort of mandatory distribution. Now, mandatory distributions most commonly are taken as RMDs when you become 70 and a half, and then every year thereafter. So somebody that's 72, while they may just be providing the annual fair market value, it's considered a taxable valuation because the value of their RMD is calculated off of that 1231 valuation. Whereas for someone in the same position that is, say, 50 years old, it's just an annual valuation, not a taxable one, because they have no RMD being calculated off of that value. So it's, again, important to understand. If you are someone that has an inherited IRA that's taking it out over life expectancy or over you are going to fall into that RMD category. Your annual valuation is not just an annual valuation, it's also a taxable valuation. So when we go through this process and we look at real estate, I want to start by saying, before I even get into the assets, I'm going to step back. These are industry standards. Now, what does industry standards mean? So the way that most companies in the self-directed space are set up is they're set up as trust companies. Now, most trust companies are domiciled in certain states. Our state, the state that we are domiciled, and it's the state that has the most self-directed custodians domiciled there, is South Dakota. So South Dakota has a division of banking that audits and oversees the trust companies. They can only provide their approach to valuations, but they can't speak for the IRS either. So when we say industry standards, it's an amalgam of previous case law, previous information that the IRS has distributed, as well as regulatory requirements, maybe by the state that we're domiciled in, which can vary from state to state. And all of that is put together to kind of create industry standards. And that industry standard says, as a custodian of a self-directed account, what are we willing to accept from a valuation standpoint? And what are our requirements around fair market valuations? And every individualized custodian in this business reserves the right to set these how they want. So I will talk a little bit about how we approach this. Again, we are part of industry groups and associations, so we do follow best practices. But I want to make sure you understand our approach to this process is what we believe as a custodian provides you as an individual account holder the best likelihood of being within the appropriate guidelines that the IRS has, even though there's no pure definition. But I want to make sure everyone understands it's their responsibility as the account holder, if you're going to buy hard to value assets, to ascertain value. So in the event that the IRS were to challenge one of our account holders, NewView has no responsibility in that. That would be the taxpayer and the IRS. And in most cases, when they do challenge the value, it's because the taxpayer in a lot of cases may be trying, right, to reduce the value to minimize taxes. So make sure that you're adhering to whatever standards you feel are best. I'm going to walk us through what we as custodian and what really the industry kind of asks for and how we approach fair market values. I'm going to pause here. I've got a couple questions that have come in. One question says, will this be available for viewing afterwards? And the answer to that is yes. These are all posted to our website. Let me see. It says, what are the requirements of checkbook LLC versus NewView as custodian? I don't know how to answer that. If the question is geared, and you feel free to type in more if you want to restate the question. If the question is geared around how does checkbook LLC work, I can't speak to that on this. I don't have the time to get into that. We do have recorded webinars on our website that will explain that. I will talk specifically about how you value assets. When you have a checkbook LLC, and no matter what, you still have to have a custodian. That custodian is still required to file a 5498 on your behalf. So they will request a value. But instead of requesting value for individualized assets, we will request the value for the LLC. And we'll talk through that here. But if that doesn't clarify, please, feel free to add a little bit more to that. Let me make sure I've got all of the appropriate questions. All right. All right, so there is a little more in there, and let's address these, and we'll see if that answers the checkbook LLC question. So let's start with real estate. So there's lots of ways that values can be placed on real estate. The nice thing is there's a actual certified property appraiser that can value real estate. So there are ways to get to a very precise third-party approach. Now, most people would say, well, that's great, but I don't want to have to pay for a property appraisal every single year. And we completely understand that. So these are standards again, but as a process for real estate, individual parcels of real estate, we will accept on an annual basis, again, a non-taxable valuation, but rather an annual valuation. We will accept both tax appraiser information, so your local county property appraiser or tax assessor will list a value. You have third-party sites like Zillow and Trulia and other places that will also provide that, as well as BPOs. A BPO is a broker price opinion. That means that you could go to your local Keller Williams or Century 21 or Coldwell Banker office, and the broker could review the homes in the area and provide a BPO. And that means that they've done some assessments to determine what's the average square foot in the neighborhoods, what are the comps representing that property or parcel, and then what may be different in this particular property than some that's sold that may raise or reduce your price per square foot. And then ultimately a price will be derived off of that. So the tax assessor, as well as the BPO, would be acceptable for annual valuations. Excuse me. If you are going to be engaging in a taxable valuation, so you want to withdraw that piece of real estate as a distribution, or you want to convert it, or you're over the age of 70 and a half and the value of that real estate will now be calculated into your RMD amount, then we recommend and encourage a real estate appraisal. And the reason for that is, in the event that you took a withdrawal of a piece of real estate, the IRS at any point could come in and ask, how did you get to that price? And the only true way that we've ever come across where you could clearly show from a tax standpoint that that was 100% an independent valuation is to use the real estate appraiser. Some people can, make the case that a tax assessor is doing the same thing, but I think if you go back to case law, there's lots of different times in lots of different scenarios where the IRS has showed that really a full-blown real estate appraisal is the only true way to know exactly what that is. And the hard part is, if you do that, you can't go back and do it, right? It can be a little bit of a challenge. So I know it may cost a couple $100. However, think of that as an insurance policy, right? You're buying the ability to not have to worry about the IRS challenging your value without being able to provide declaration. Promissory notes. Now, you notice there is no red, meaning from an annual valuation standpoint, annual valuation and taxable valuation is really the same standard. For promissory notes, on interest-only loans, it's the face value. So if I write a $50,000 loan and I'm collecting interest payments, as long as it's current, it's the face value. It's worth $50,000 because there is no accrued interest. It's all simply being paid. For amortized loans, it would be the amortized value. So we would take you as the account holder would take the loan terms, how many payments have been made, go across to determine how many principal payments and what's the new balance of that loan. You would add in if there's any additional accrual that may be happening or any sort of equity kicker at the end, right, from a valuation standpoint. But ultimately, it would simply be the amortized value. Now, you'll notice the asterisk because loans in default will have more requirements for valuation. There is no one-size-fits-all approach to valuations of loans in default. It has a lot to do with what's the collateral, what's the recourse. And so, we recommend, depending on what type of collateral and where that is, to get some sort of third-party valuation, especially if you're devaluing, right? It's really important because think about what the IRS sees. If they see a loan that you bought for 50 grand that you're devaluing to 20, in their eyes, they may see that as, hey, why would this taxpayer drop the value $30,000 from a tax standpoint? They may assume that it has to do with you trying to avoid paying taxes on the full 50 and rather only paying on the 20. So we always recommend, looking into third-party valuation. So in the event that you had a promissory note that was secured by real estate that's gone into default, then I would look to the value of the real estate, right, to help determine how much that note may be worth. So there's some strategies there as it relates to assets from a loan or debt obligation that are in default. Moving down to checkbook LLC or asset entity or asset holding entities. Again, this could be any sort of entity that's created for the purpose of holding assets, right? Any entity created for the purpose of holding assets. Generally, it falls down to the value of the individual assets. So for example, if I have a checkbook LLC that I set up and I went out and bought 2 rental properties, to value that LLC, it would be the value of each individual piece of real estate. So I would go back up to real estate. And if this is just an annual value, right, I may take the tax assessor's value. I would add property A and property B together. I would then take the value of any cash receipts that have come in. So if I've got property A is $50,000, property B is $50,000, I've got $10,000 of cash, then I, as the manager of that LLC, would report back to the custodian, the value is $110,000. Now, we always recommend that anytime you do that, especially if you are the one performing the value, that you always want to put a substantiating document behind it. Why? Because if the IRS comes and audits you 5 years down the road, we as custodian, neutral third party, can produce stuff on your behalf. So if that fair market value has printouts of the tax assessor's value of each of those and a bank statement to validate the $10,000, now if the IRS comes and asks any questions, you could easily produce that as to the justification of how you got to that value. And that's the part that's always important. There is no other real approach for checkbook LLCs or requirements. We do require that the manager of that LLC be the one, or a third party be the one that signs off on that. We always recommend anytime you're performing valuations, you are always better protected if you have a disinterested third party sign off on your valuation. And the reason for that is, again, if the IRS audits you 5 years down the road and they look and see your name as the valuator versus Bill Smith, some disinterested third party, you create a barrier to show arm's length. So it's important to make sure that if you have the ability to have someone else validate that value for you, not because they're certifying it, but they're just saying, based on, you know, the information that we've seen, this is the value. The more you do that, the better, which is why in real estate, that BPO is always a nice thing. Lastly, operational entities. Now, this is the one that gets into be a much more difficult approach, because how much is Microsoft worth, right? Well, Microsoft would be a real challenge to value. Now, thankfully, there's a share price, and share price, you know, helps determine its overall value as a company. But in the private world, there is no moving ticker symbol for share price to be multiplied by all the shareholders to ascertain value. So from a standpoint of private companies, it's very important that you find a good way to determine value. Now, there's a lot of standards. So there's a lot of groups that use EBITDA, right? Earnings before interest, taxes. And so that EBITDA provides you a number. And then there's usually a multiplier, and there's industry standards, right? Some companies sell it at 3 times EBITDA, 4 times EBITDA. And so what you'll see in red is we want to kind of focus from an annual standpoint on what's the business value. And some companies will base it on outstanding shares, and they'll update their share price annually. And it's the number of the share price times the number of outstanding shares. Some other companies use some revenue or EBITDA calculations. All of those things can work. CEO, CFO, or CPA declared values. Those are always great because, again, you've got some true kind of third party away from you, the account holder, that's saying, based on this, this is the value. And we always encourage investors into these types of assets to ask for that, because you should get an idea every year, if you've invested into somebody else's business, what that investment is worth, right? And then there are third-party appraisers that do business valuations. They tend to be very expensive. We see this in large syndicated deals, but we understand it's probably not something that you're going to get if you're the lone IRA investor into a small business. And that's where that CEO, CFO, or kind of third-party CPA declaration comes in. And all of those people would have information or material needed to determine the appropriate value. There is no perfect way to do any of these assets, you know, nor is there a prescribed way by the IRS. But what I think and hope that you got out of this is an understanding of at least directionally where you want to be. What I always come back to is, question you should ask yourself from a valuation standard is, if the IRS came and asked me how I obtained this value, right, would I be able to rely on enough information for them to feel like it's a true representative of value? If you plucked it out of thin air, it's probably not going to be a good representation of value. But if you worked with third parties or appropriate groups to get a value, in most cases, we've seen that that's plenty sufficient for the IRS. So in conclusion, for this slide, make sure that you know the difference between whether this is an annual valuation or a taxable valuation. And if it's a taxable valuation, the threshold should be a little bit higher so that you never have to worry about the IRS in any way challenging your value. And when it comes to you having a value that has a tax implication, they're going to be a lot more stringent on that value, because the opportunity for you to produce a lower value saves you tax money. And that's what they're really trying to police against. From an annual standpoint, I won't say they're not concerned, but they're a lot less concerned because there is no real tax implication to you, but they still want to make sure that directionally you're producing and providing the custodian with a representation of what that is worth, again, as close as possible, so that you know what the account's worth and so the government can do their appropriate tax forecasting for future taxes. That is the last slide I have. Let's see, as far as questions that have come in, and let's get wrapped up here. So one of the questions says, for clients with Roth accounts, why is an annual valuation required? Taxes have already been paid. That's a good question. However, as custodian, the IRS does not differentiate between account types. So we do not have any differing requirements for Roth accounts versus traditionals. Maybe if the IRS takes the guidance of the governmental office that suggested, maybe they'll provide some separation, but until then, they're all treated the same. The second part of that is taxes, while taxes may have been paid going into the Roth, not all Roth distributions are tax-free. They have to qualify, meaning they have to be held 5 years. There's some nuances to that. And so when we report to the IRS, we don't report whether you owe taxes or not. We report that an activity occurred that may generate taxes. So we still are required to report the annual fair market value for Roth accounts, as well as the fair market value from a taxable potential on any distributions via 1099. Even for Roth accounts, we will produce a 1099. Whether you have to pay taxes or not is between you and the IRS. So I'm with you. I don't know why they require it. I can see some scenarios where it is and should be required, but until there's further guidance, it has to be produced on an annual basis. Now, one thing that you could, as a Roth account holder, determine is that if you're 72 and you have a Roth IRA, you may not produce, have the property appraised because it's not a taxable valuation. It's just an annual valuation. So you may not go to the same lengths that a traditional account holder would go through from a taxable standpoint, but you still need to be producing that annual valuation. All right, let's see what else has come in. Somebody asked about specific investments into a particular investment. I can't speak to any one particular investment. We have way too many people on today to cover that. But what I can tell you is if the investment is into a third-party investment, right, like a limited partnership or LLC, then you'd want to understand how do they value it, because we would refer to those parties as investment sponsors. And most of the time in syndicated deals, the investment sponsor is producing the fair market valuation on your behalf. And you'd want to understand from them what they go through to determine fair market value. We are simply the recipients of that. We are not the ones that determine that process. Let's see, what else? It says, can a land trust be taken as a distribution after 59.5 from a Roth? And the answer is yes. We would need the fair market value of that land trust at the time of distribution. If the land trust is being used as a holding entity, then it would be the value of all the underlying assets inside that land trust. So if you just had a parcel of real estate, we would need the fair market value of that real estate and then make the distribution to the account holder. For operational entity with CEO, CFO, or CPA declaration of value, is the manager of the LLC acceptable for producing this, and does the manager have to provide additional supporting documentation? So yes, we use CEO as a title because there's some rationale behind it, but if there is no CEO or CFO, but you invest into an LLC that has a manager, right, the person in charge of that, someone that would have the necessary information to be able to produce a value, then yes, that would be acceptable. As far as supporting documentation, the question was, should I ask for supporting documentation? And the answer is always yes. If you invest into someone else's offering or deal, you should never rely on them just telling you it's worth X. Right? You should always want to see as much supporting information. So understand that while we talk about fair market value from an IRS standpoint, fair market value is equally as important to you as an account holder, because you should want to know, if you've invested into something, what is it worth? What decision should I make as it relates to this investment? So great question. Yes, managers can produce values for LLCs, and supporting documentation, no matter what you do, should always be requested, especially from third parties that are in control of the money. All right, I think, let me just do one more check, since there's two places people can ask questions. Let me make sure I got them all. Give me 1 second here. Wonderful. Well, it looks like that is all the questions. I appreciate you guys sticking on a few extra minutes and asking the questions. Hopefully, this webinar provides you some insight. Please note that it is not legal or tax advice, nor are we the IRS. Please go out and make sure that you're doing your own due diligence and obtaining values that you feel comfortable relying on as the true fair market value of that asset. And if it's going to be a taxable valuation, make sure that you're raising that litmus test so that you have the confidence that if the IRS ever asks, you have clear third-party documentation to support its value. So thank you very much for joining us. We look forward to having you guys on future webinars. But thanks again, everyone. Take care.